Good Monday, this is Jay Brew, co-chairman of Seafried and Brew. An article that had caught my attention today in the Financial Times. Regulations hit smaller U.S. banks hardest. We as community bankers love to see an article like that. But let's go through the different things they talk about in terms of what's happened based on their numbers, because this was a Harvard bank study that just came out looking at the changes in community banking versus large banks. And what it says is that market share 2006 to 2010 had declined 6%. After 2010, down 12%. They also went into share of lending market. The community banks in 1991 held 40% share in the lending market. In 2014, that had dropped to 22%. Along with it, the five biggest banks in 1991, 17%, rising to 41% in 2014. So almost a complete switch. And one of the authors, Marshall Lux, who was a senior fellow at Harvard's Kennedy School, said, "What if Dodd-Frank created a too small to succeed problem in addition to the too big to fail problem?" Wonderful for community banks that this kind of message can be sent to Washington, saying we need more regulatory relief because there's studies backing that community banking is sliding. One of the things that could support that, for instance, is that I was asked to do an article on the efficiency ratio. And it was interesting because when I analyze banks, efficiency ratio is one of the things that you look at. But as I've said before, looking at a community bank is like looking at a diamond. You have to study each one of the different facets. So when I went back and started to do some research on this, is that we can see over the last 10 years, going back to 2004, that efficiency ratio started to increase as we went through the financial crisis. As we came out of it, it's come back down. But when we see it's only come down to a 70% ratio reading. Do you remember in the day that a 65% efficiency ratio was really what everybody wanted to try to attain? And yet when we look at this, the industry hasn't been at 65% for the last 10 years. So one could argue that it backs up what that paper is saying, that when we look at overall regulatory effect in terms of earnings, in terms of efficiency, that there has been an impact. But now this is where I think fiction is better than truth, or truth is better than fiction, because when we look at it, I can't figure out, for instance, how this Harvard study came up with the fact that regulations have hit community banks hardest. I agree with the thing from the standpoint of the definition of the efficiency ratio. And let's go through that definition. The efficiency ratio is defined as non-interest expense less the amortization of intangible assets divided by fully taxable equivalent net interest income plus non-interest income. So when we look at that equation, is what we did as part of the paper that I wrote, is that we went back and we looked at each part of the equation. Interestingly enough, that non-interest expense and the non-interest income, which is equivalent to net overhead, has actually come back to levels that we saw before the financial crisis. So interestingly enough, the expense side of the equation is not really reflecting that regulatory situation. When we look at the efficiency ratio, what we found out is that it really was the net interest income, fully taxable equivalent dollars, is what has decreased over this past 10-year period of time, and that's what's keeping the efficiency ratio up. So when we look at it from regulatory expense side, one could argue that, yes, net overheads were up during the financial crisis and the Great Recession, but we know that was due to higher legal fees around lending issues as well as other lending type expenses. So when we think about that, that now has come down to a more normalized type level, and it doesn't show that net overheads have actually increased over this period of time. So it really is a factor in terms of that net interest income in total taxable dollars. And that overall in the industry as a percentage has declined. That's what's affecting the efficiency ratio. So now let's look at another thing in terms of that lending. Remember the charts I was just showing that showed community bank lending decreasing in here on an overall basis. When we look at it though, let's look at the actual facts. And I think that this is really an incredible number. That when we look at 2012 coming out of the Great Recession is that loan growth over 5%. 2013 rising to 7%. And our numbers are in for 2014, 9.7% growth in loans, which I think is just incredible considering where interest rates are, where overall lending is in terms of what pipelines look at, is that essentially the community bank industry has done an excellent job in terms of growing its loans in this kind of environment. So once again, when we look at an article like that, it's great to send it to Washington to sit there and say, look at what this Harvard group is saying about this. But in fact, when we really look at the underlying numbers, is that we've been able to really bring our net overheads down. Once again, I think strategically they could come down further, but these are positive trends in the industry, even though we know regulatory costs have increased. This is Jay Brew, co-chairman of Seafried and Brew. Have a great week.